So let's work on some Chapter 10 practice problems. And so if we look at question 1, we've got a company's perpetual preferred stock. So we're looking at preferred stock, currently trades at $80 per share and pays the $6 annual dividend per share. If the company were to sell a new preferred issue, it would incur a flotation cost of 4%. So that wasn't something that we considered before, but it's a really easy adjustment to make if we solve for this. So the question is, what would the cost of that capital be? So the cost of preferred stock is equal to, well, it's the return on preferred stock, or the cost, is equal to the dividend for preferred divided by the price for preferred usually. It's just that. But since we have a flotation cost, we're going to multiply this by 1 minus the flotation percentage in this denominator. And so the dividend was $6 and the price was 80. And I'm going to multiply 80 in this denominator times 1 minus 0.04. And so you'll end up getting 7.81% because of the flotation costs. And just keep in mind, if it didn't say flotation cost, then we would just be dealing with this little part over here as the equation. So that's the normal way we look at it. So let's go to the next one. Something Company Inc. hired you as a consultant to help them estimate their cost of capital. You have been provided with the following data: the risk-free rate, the market risk premium, and beta. Based on the CAPM approach, what is the cost of equity from retained earnings? So this is just saying use the CAPM equation where you have the risk-free rate plus beta times the market risk premium. And so this one is a pretty easy one. The risk-free rate is 5% plus the beta, which is 1.1, times the market risk premium, which is also 5%. And so you get the cost of equity from retained earnings is equal to 10.5%, which is answer A. So let's look at the next question. So remember, we're ultimately, in one of the questions, we're just going to find the total weighted average cost of capital because that was the point for this chapter. So question 3, Rhino Inc. hired you as a consultant to help them estimate their cost of capital. You have been provided with the following data. D1, or the next expected dividend, is $1.30. P0, the price today is $40, and G, the growth rate is 7% and it's constant. Based on the discounted cash flow approach, what is the cost of equity from retained earnings? So in the question before, we were using the CAPM approach. Now we're using the discounted cash flow approach. And so that equation is RS is equal to D1 over P0 plus the growth rate. And remember, we do this together before we add the growth rate. So D1, they said, was $1.30. The price they gave us was 40, so we'll divide that first. And then the growth rate is plus 0.07. And I put that in a decimal form because this part over here will be in a decimal form. And so what you'll get is that the answer will equal 10.25%. And that's answer E. So far we've looked at the cost of preferred stock and the cost of equity from retained earnings. And now we have some data because we're going to estimate the final answer, the weighted average cost of capital. So Since this is like a lot of data, I usually kind of look at what is the first question. So I would look at question 4, and it says, what is the company's after-tax cost of debt? So I know that I need to look at the debt information. And the debt information is up here. And usually for the cost of debt, we want the current market cost. And the way we can get that is by computing the interest rate. So compute I to be able to get the current market rate. And then since the question asks for the after-tax cost of debt, we're ultimately going to find this. Rate of debt after tax is equal to the rate of debt that we get times 1 minus the tax rate. So first we've got to get the rate of debt. And so let me scoot this down a little bit. Oh, that didn't work. Okay, so I need to write down my time value of money keys. And I'll have a present value, a future value, an N, and a payment. And then I is what we're solving for. So the present value is the price of the bond. And it says that they currently sell for $9.45. So I'll put $945 is what I'd have to pay to invest in this bond. The face value, like we know, it's usually 1,000. So that's the future value. N, it's a 20-year bond. So I'll put 20 for N. And the payment, it's an 8.5% annual coupon bond. Remember, to get the payment, you multiply 8.5%, or we could just multiply it down here. That's 8.5% times 1,000 because it's expressed as a percentage of par value. And so the payment amount is $85. Now we have our payment, and you would enter these pieces of information into your calculator. And when you compute I, you'll get 9.11%. And so you guys can refresh your memory on how to compute that in the calculator. But that's not the final answer, okay? That's just the cost of debt, RD, just that part. But we want RD after tax, the rate of debt after tax. So that's going to be equal to the 9.11% that we got times 1 minus the tax rate. And the tax rate up here they said was 40%, so 0.4. And so we get the final answer is equal to 5.46%. So you can see that that 9.1 answer was there, but that wasn't the correct answer because it asks for the after-tax cost of debt. And so the next question, well, I guess I gave myself a lot of room there, but I didn't use it. What is the company's after-tax cost of preferred stock? So I just want to write the equation for that. The rate, or the cost of preferred stock, is equal to the dividend for preferred stock divided by the price for preferred stock. So I just need to go back up here and look for that information, the dividend and the price. So it says right here that the company has outstanding preferred stocks that pays a $2 annual dividend, and the preferred stock sells for $25. So I've got the numbers 2 and 25. So I'll just put 2 divided by 25. And if I do that, I get 8%. And that's answer D. And then if I go down to this question, what's the company's after-tax cost of common equity? Let me go back up and see what type of information did they give me. Did they give me the CAPM stuff, or the discounted cash flow method, or the bond yield plus risk premium method? So the cost of common equity So it looks like for that they gave me beta, the market risk premium, and the risk-free rate. So I'm going to use the CAPM approach because of this. And so beta is 1.2, market risk premium is 5, and the risk-free rate is 6. So let me go back down here. So the CAPM RS is equal to the risk-free rate plus beta times the market risk premium. And so they said the risk-free rate was 6%, beta for the stock was 1.2, and the market risk premium was 5%. And when you multiply and add, you'll get that the cost, well, after-tax cost of common equity, there's no such thing as an after-tax cost, but the cost of common equity is 12%, so we get 12%. And then the final question says, what is the company's weighted average cost of capital? So the equation for that, it's equal to the weight on debt times the rate on debt times 1 minus the tax rate plus the weight of preferred stock, and that's a W. Oops. So the weight for preferred stock times the rate on preferred stock, and then the weight of common equity times the rate on common equity. So I need to look for the weights that were given. So I'm going to scroll up again, and I'll have to use my answers that I got in these previous questions. Okay, so the company's capital structure consists of 40% long-term debt, 40% common stock, and 20% preferred stock. So I need to remember 40% and 40% and 20%. And then the answers that I got for the previous questions. Okay, so the weight on debt, it was 40%. Remember the answer we got for the rate on debt, it was 9.11%, and then times 1 minus the tax rate, so times 1 minus 0.4, plus the weight for preferred stock, and that was 20%, and the rate for preferred stock that we got as a previous answer was 8%, plus the weight for common equity was 40%, and the rate that we got from our calculation just before this one was 12%. And so the grand finale to get the WACC is that when you multiply this, you'll get 8.59%. So this would be the rate that's used to compute the NPV for the firm's projects, the average project. And that's in the next chapter, I believe. So those were just a few practice problems for chapter 10.